President Trump is now promising a new 50% tariff on China, on top of the other new tariffs, which are on top of existing tariffs. Combined, this would make U.S. tariffs on imports from China a whopping 104%.
The Finance Ministry has just made an announcement that remember there were 34% tariffs on all U.S. goods coming into China. That's now been increased to 84%.
Trump is clearly on edge. And this time, it feels different. On April 9th, he announced a 90-day suspension on most tariffs previously imposed on U.S. trade partners. It didn't come as a shock. Wall Street reacted with a brief wave of optimism. But that boost didn't last long. He seemed to overlook a key detail. China wasn't exactly pleased by this delay. Quite the opposite. Instead of easing tensions, Trump actually hiked previous tariffs from 104% to a staggering 125% on Chinese imports. Beijing didn't hesitate to retaliate, slapping American goods with tariffs as high as 84%. Whatever hope there was quickly vanished. Trump had underestimated Beijing's response. Fast, strategic, and razor-sharp. China is no longer just reacting. It's dictating the tempo of this global chess game. The Asian superpower isn't taking advantage of the tariff pause. In fact, Washington's increase in duties marked an escalation. And Beijing's lightning-fast counterstrike left no doubt. They're not backing down. But here's where the real storm brews. And it's not in the tariff war. It's in the financial markets. For days now, private memos and financial briefings have warned of a bold, potentially destabilizing move from China. The threat of dumping U.S. Treasury bonds on a massive scale. Such a step wouldn't just shake Wall Street, it could send shockwaves through the global economy. With an estimated $900 billion to $1.1 trillion in U.S. debt held by China, selling even a portion could be like detonating a financial earthquake at the heart of the system. The stakes have officially outgrown a simple trade dispute. This is now a battle over economic influence, with long-term implications. What once seemed like a theoretical risk now feels dangerously real. For years, analysts speculated whether China would ever weaponize its Treasury holdings. Now, amid an escalating tariff war led by Trump, the prospect of that scenario is starting to gain traction. Recent reports suggest that the Chinese central bank may already be under quiet instruction to reduce its exposure to the US dollar. On financial forums and within social media circles, leaked internal documents are circulating. They indicate that state-owned banks have been told to scale back their dollar purchases. A clear signal that Beijing could be preparing for a major shift. Some analysts even claim that discrete sales of Treasury bonds have already begun. Nothing too loud. Just enough to test the waters without triggering alarms. This isn't new in theory, it's been discussed for years. But this time, the situation is different. With tariffs rising and tensions boiling, Beijing seems more willing than ever to absorb some financial pain in exchange for geopolitical leverage. And economists around the world are sounding the alarm. If China moves to offload a substantial chunk of its Treasury holdings, the consequences for the U.S. could be dire. A sharp spike in interest rates, inflationary pressures, and a serious blow to the global standing of the dollar. Yes, China would also take a hit. But that may be a price they're ready to pay to send a message. They won't be cornered. This is the context behind what financial analysts are now calling the nuclear option, a term that once sounded dramatic, but is now being referenced seriously by Bloomberg, Reuters, and other heavyweight financial outlets. If Beijing follows through, the tremors would be felt first in long-term bonds, then in real estate, and finally in the everyday lives of millions of Americans. For Trump, especially in the heat of a presidential campaign, it could be a nightmare scenario. But China isn't stopping there. Beijing is quietly reconfiguring its entire financial strategy. While the world watches the tariffs, China is moving on multiple fronts. Accelerating the rollout of its digital yuan, reducing its reliance on the dollar, and signing bilateral trade agreements with countries across Asia and Africa that allow local currency transactions. What looked like a trade spat has now evolved into something far more complex. A high-stakes struggle over the architecture of global finance. And this time, the outcome is far from certain. Markets in the U.S. are already reacting. Over the past few days, signs of nervousness have intensified. Treasury bonds are being sold off at a faster pace. Prices are dropping, and yields are rising, meaning it's becoming more expensive for the U.S. government to borrow money. This creates ripple effects. Mortgage rates rise. Credit tightens. Consumer spending slows down. The fiscal health of the Trump administration is under pressure, and that pressure is building by the day. Investors are beginning to lose confidence in what has long been seen as one of the safest bets in finance: U.S. debt. And the reason is fear. Fear that China could flood the market at any moment, sending bond prices tumbling and yields soaring. Institutional investors, insurance giants, banks, and even foreign governments that traditionally snapped up U.S. treasuries are reassessing their positions. If China pulls the trigger, the dominoes could fall fast. And this wouldn't be a localized crisis. It would have global consequences. Even typically cautious outlets like The Guardian and Forbes have started raising red flags. Headlines talk about deepening panic, risk to the U.S. rally, and a potential collapse of the housing market under rising interest rates. All this is happening while Trump maintains his combative rhetoric, claiming the trade war is winnable and the tariffs are essential for American prosperity. But behind the scenes, leaks from Washington suggest a different mood. Officials admitting the door to talks with Beijing remains open. That contradiction is adding fuel to the uncertainty. And uncertainty in financial markets is gasoline on a fire. Seasoned economists are now warning that the fallout won't just be economic. There's a growing concern that this could lead to a collapse in global confidence in the U.S. as an economic leader, at precisely the moment Washington most needs to project strength. If current trends persist, the possibility of a recession hitting in 2026 is no longer a fringe concern. It's becoming a mainstream fear, even among the most bullish analysts. For years, the notion that China could use its U.S. bond holdings as leverage was seen as a far-fetched idea. Many believed Beijing would never go that far, since dumping bonds could hurt their own financial stability. But that calculation may be changing. As the trade war escalates and tariffs tighten, China might be prepared to accept short-term losses in exchange for long-term geopolitical advantage. It's the equivalent of sacrificing a piece in chess to check the king. Because this isn't just about how much China sells, it's about the message it sends. A sell-off, even a modest one, would be a symbolic withdrawal of trust in the U.S. economy. And that's more than enough to shake investor confidence. China isn't making reckless moves. Everything they're doing seems carefully measured. The strategy to reduce dollar reserves and diversify into alternative assets isn't a knee-jerk reaction. It's a long-term pivot. This transformation suggests a larger vision, insulating the Chinese economy from future sanctions and building a parallel system where the yuan, especially its digital version, plays a central role. Meanwhile, on Wall Street, anxiety is spreading. Hedge funds, private equity firms, and even small asset managers are glued to every signal from Beijing. They know that even a subtle shift in China's bond holdings could set off a chain reaction that's hard to stop. And while Trump continues to double down on tariffs, some believe he's gambling that China will blink first. Others think he's dangerously overestimating his position. More senators are now speaking out. One recently warned, "If we stay on this path, we might unleash a crisis that spins out of our control." And the pushback isn't just from Democrats. Increasingly, Republicans are voicing concerns too, questioning whether this trade war is worth the risk. If this spiral continues, the political and economic cost for the U.S. could be devastating, especially with another election around the corner. What began as a dispute over tariffs and trade policy has morphed into something far more dangerous, a financial confrontation with global stakes. And this time, it's not just about goods or duties. It's about control of the financial future. Among analysts and commentators online, a new phrase is making the rounds: the final card. That's how many are describing China's potential move to unload a significant share of its U.S. Treasury holdings. If they go through with it, there may be no turning back. It would mark a definitive break in the trust that has underpinned U.S.-China economic ties for decades. But would China really pull the trigger? Some experts believe yes, but not all at once. Instead of a dramatic crash, they foresee a gradual and strategic rollout, selling off bonds in daily increments that are just large enough to cause pain, but small enough to avoid outright panic. That kind of pressure campaign would have multiple effects. It would push up bond yields, making U.S. borrowing more expensive. It would inject volatility into the dollar, deterring foreign investment. And above all, it would send a direct warning to Trump and his economic advisors. Push us, and we'll push back harder. Yet this isn't China's only play. They're also redrawing the regional trade map. Beijing has strengthened its partnerships with neighboring countries and with parts of Africa, promoting local currency deals and shifting away from dollar-dominated systems. On top of that, China's digital currency, once seen as a futuristic experiment, is now being woven into its real-world trade infrastructure. The goal is simple: to build an alternative system, one that can function without depending on the dollar or US-controlled channels. What's happening isn't just a reaction. It's a long-term strategy, a roadmap toward financial independence and resilience. Meanwhile, the pressure keeps building in the US bond market. Prices are dropping, yields are climbing, and fear is spreading. Investors worry that this might be the beginning of something much larger, something unstoppable. Trump has tried to calm nerves with public statements like, "We're ready to make a deal. We're just waiting for the call." But markets aren't buying it. The rhetoric feels disconnected from reality. Beijing wants tariffs gone. Trump wants them in place. And so, the deadlock continues. As the standoff deepens, all eyes are locked on two capitals, Washington and Beijing. And the question echoing across trading floors, newsrooms, and policy circles is blunt but critical. Who's going to blink first? This is no longer a game of negotiations or diplomatic sparring. The threats are no longer subtle. Each move is countered. Each signal met with a response. And markets are responding with a level of volatility not seen in years. For decades, U.S. Treasury bonds have been considered the bedrock of global financial security. But now, that bedrock is cracking. Prices are slipping. Demand is cooling. And the once unshakable perception of safety is fading fast. Some sovereign wealth funds are already making quiet moves, diversifying portfolios, reducing exposure to U.S. debt, or simply waiting to see who moves first. China with its silent sell-off, or the U.S. with a policy shift. No official confirmation has come from Beijing about a large-scale bond liquidation, but the market itself is already speaking. Yields are rising. The dollar is showing weakness against major currencies, and investors are bracing for what comes next. In Washington, the internal debate is intensifying. Trump's hardline advisors insist on staying the course, arguing that any concession now would signal weakness. But moderates are starting to worry that the tariff strategy may have already crossed a dangerous line. More lawmakers are raising concerns from both sides of the aisle. A rare consensus is forming. This economic war may end up costing more than it could ever deliver. The ripple effects are already hitting key industries: agriculture, tech, and manufacturing. Uncertainty is stalling investment and fueling fear. On the other side of the world, China continues to act with deliberate precision. The message is consistent. They're not looking for all-out conflict, but they won't tolerate unilateral pressure either. And if necessary, they will use every financial tool at their disposal. Which brings us back to the so-called red button. China doesn't need to hit it all at once. They can ease back on bond purchases. Let existing holdings mature without reinvesting. Make under-the-radar trades. Each of these steps chips away at the market without a single headline. Investors online have captured this strategy in one haunting phrase: "You don't have to launch the missile, just show them it's armed." That, perhaps, is Beijing's sharpest move. In this high-stakes battle filled with economic tension, global anxiety, and geopolitical recalibration, one thing has become undeniable. U.S. Treasuries are no longer a neutral asset. They're now a weapon on a very real financial battlefield. Trump continues to argue that this is a path to long-term national strength. But markets aren't buying the vision. They're reacting to the present, with fear, sell-offs, and mounting speculation. And the specter of a 2026 recession is no longer abstract. it's gaining shape. Meanwhile, in China, the moves seem deliberate and coordinated, from shifting away from the dollar to building trade corridors independent of U.S. influence. Everything points to a push for autonomy and a global repositioning. Chinese media calls it a necessary defense. Western outlets, in contrast, see it as a silent financial offensive. But across the divide, one truth remains. If this escalates further, everyone loses. History has already taught us what happens when trade wars and financial shocks collide. Prolonged stagnation, global downturns, and hardship on every continent. The comparisons to the 1930s aren't made lightly. And so, the world waits. Will Trump walk back his stance before irreversible damage is done? Or will China pull the trigger and send shockwaves through the world's financial core? What is certain is that the globe is watching. Not just investors and economists, but everyday citizens, governments, and central banks. Because if confidence in the dollar breaks, the aftershocks won't stop at the border. No one will be spared. This chapter of global economic conflict may be nearing a boiling point. But the story isn't over. Tell us what you think. Will China actually fire its bond weapon? Or is this all part of a pressure game to force a better seat at the table? Subscribe to stay updated, because no matter which way this goes, one thing is clear. This is just the beginning.